All right, well, let's unpack what's going on at a macro level now. Clifford Bennett joining us from ACY. Clifford, good to see you.
Good morning, Andrew. Great to be here as always.
Just before we get to the RBA and its decision this afternoon, let's take a look at that data we saw out of the States with services. Obviously, that strength there. What's your takeaway from those numbers?
It's just a terrible number because it means that the Federal Reserve will be hiking all the way to a much higher level than the market currently anticipates. And it's the same with the non-farm payrolls at the end of last week. There was nothing good about the number. It suggested employment staying firm, which to the Fed, in their mind, means we should keep hiking rates. They might even do 75 points at this last meeting one more time. My forecast is 50. But again, that services index data yesterday, and it's manufacturing that's really in trouble in the US at the moment, but that services index was a positive for the economy, but really it's at very low historic levels. So it's kind of like the US economy is just trundling along, yet the Fed will be encouraged to keep hiking aggressively, I think up towards 6%, which is well above market consensus.
6, or you actually spoke to us about this on Friday, the last call, where you're saying could go as high as 6.5.
Yes.
So what's that indicate to you then? If they have to take it that high, there's that significant lag where that tightening is just not taking effect at the moment?
Well, I think the inflation is just so incredibly broad-based now, and Powell himself has said that it's across services. So even if you get some falling in prices in the goods areas, services are still picking up high inflation, and also the housing impact hasn't really flowed through to the inflation numbers yet. And that'll be happening across 2023. But also, where's the inflation coming from? It's been a supply side problem as well as a demand, or even more so, and it's a result of the war in Europe. And raising interest rates don't counter those events. So therefore, interest rates will have to be hiked very aggressively. And remember, Paul Volcker, when inflation was at 20%, took interest rates to 14. Or sorry, inflation was 14, took interest rates to 20. So, here we're still in, some people have started calling this a restrictive sort of level of Fed rates, but it's not. I think the only people who think it's restrictive here are very young economists. Anyone who's been around along knows that these are still very low interest rate settings historically, so there's plenty of room to the upside. So my central forecast is a move to 5.75 to 6.5, in that range, around 6. The outside risk is not lower. The outside risk is actually higher to 7.5 as a spike reversal.
All right, because certainly talk of a pivot have disappeared, but more talk of a pause. But what, you feel as though that's unlikely?
Yeah, I'm actually personal best, very proud of myself. I didn't giggle then. Because it's the first, here it comes. No, because there was never going to be a pivot. It was just never going to happen. Powell made that incredibly clear. I don't know where that came from. I think it came out of some hedge fund or some fund management firms, economists, that whole idea, talking their book. But there was never going to be a pivot. Rates are going to go up and they're going to stay up high. And Powell said last week, they're going to stay high for a considerable period of time. And that could be 12 to 18 months. So don't expect any sort of spike reversal in Fed fund rates. It's more likely a plateau event. Somewhere up towards 6.
So given those numbers we saw with the data overnight, as a result, those bond yields moved higher. The US dollar also...
Wonderful run by, yeah.
Yeah, that moved higher. But, I think I asked this before, whether we have seen the peak in the US dollar. What are your thoughts there of where it's tracking?
Well, I was starting to think, because I see the US dollar as having entered bubble territory. So it is a bubble market where a whole lot of fear is driving the buying of US assets from the rest of the world, pushing the US dollar higher. US corporations are panicking, bringing their money back home, pushing the US dollar higher. The Fed's hiking aggressively, is going to continue. So a lot of people just think, put the money in the US dollar. But it is becoming a bubble because it's stretching away from the underlying fundamental realities, which are massive trade deficits, massive fiscal deficits, and a manufacturing sector that's slowing badly. So it is a stretch away from its underlying reality. I thought we might be seeing the peak in the bubble, but it looks like it has further to run. So I would be very cautious on the Australian dollar. If I was a mining company in Australia at the moment, I wouldn't be hedging my US dollar exposures. I'd be watching, waiting for a few months here, see how low the Australian dollar can go again.
And we look at other assets, in particular gold, which has done very well over the last month or two, having been beaten down for so long, certainly over the course of this year. And that inverse correlation we see with US dollars. So how are you looking at gold at the moment then?
Well, I'm a gold bull. And I also bought some Australian gold stocks yesterday. And I think that's going to be cushioned, this down move in gold. The Australian gold stocks will be cushioned by an equally or even more significant fall in the Australian dollar. So I think gold from the Australian point of view is still a very good buy. From the US dollar point of view, it's a very mixed bag at the moment, but overall I am a gold bull towards 2000 next year.
Does that also depend on how the war in Ukraine plays out?
It does a little. I mean, the one wild card here that no one's really talking about, Biden's made some mention, or his handlers have made some mention of he may be prepared to begin some kind of talks with Putin. If we saw a movement towards any sort of peace negotiations and an ending to the conflict, which is what we all really want to see, that could really change the equation, and I could become a stock market bull and a US dollar bear and a gold bear. But for the moment, while that war is in place, and I unfortunately see the war continuing into 2024, so while that's still in play, I think it's very difficult, and we just saw European data overnight. The consumer is sort of pulling back, and people are talking about inflation causing the consumer to pull back, but the consumer's pulling back because they're worried about the war and the conflict. And so are businesses. So that's a negative for the European economy, and it's a negative for the Western economies. This global slowdown is a European, US-led slowdown. We know China's sort of trundling along, but it's certainly a big turnaround for Europe and the United States and some other Western economies.
Just quickly, what is your view on China at the moment? Because there are mixed messages coming out of there, certainly as far as what its COVID policy is and what they're likely to do.
Yes.
It's very hard to tell, isn't it?
It is. I think there's going to be ongoing COVID dislocation and disruption, but not to the degree we've seen so far. So in other words, a moderation of disruption, but not an elimination of it. But I think the Chinese economy will continue to grow somewhere in the 2 to 5% range over the next decade.
Clifford, as always, good to have you on the
Andrew.
show. Thanks for joining
Thank
us on
you for having
ACY.
me.